Hello, everybody. Professor Barth is here. History professor at Arizona State University. It's been about a month since I last checked in. I'm in the thick of the school semester at ASU, so things are just super busy. I wish I could post a new video every few days or so, but summer's approaching, so maybe I'll be able to check in more frequently. Got to do my monthly update, Inflation Nation April update. Let's take a look at the numbers. Assess why some people are optimistic about these inflation numbers, naively so, I believe, but we'll take a look at the argument being made. And then we're going to look at the FOMC minutes and what the Fed will do next. So, this morning, the Bureau of Labor Statistics released the CPI, Consumer Price Index numbers for March, and it's the highest it's been in more than 40 years, since December 1981, 8.5% increase in consumer prices over the year. That is, again, the highest since 1981, driven by food and energy and shelter costs. U.S. inflation quickens to 8.5%, ratcheting up pressure on the Fed. And look at that graph of the CPI from 2010 to 2022. Boy, if this doesn't alarm you, how do you not look at this graph and conclude that we've got a major problem here? We've got a major problem here. And there are a few optimistic voices today. I think they're wrong-headed, and they're pointing to Core CPI. We'll look at that in a second. But this inflation is not slowing down. In my view, this is not slowing down, and this will continue to play out. Will continue to play out even as the Fed tightens, and we'll take a look at what the Fed's going to do next shortly. This is month. So this is the graph here is 12-month inflation over the year. This is month over month. So in March, consumer prices rose 1.2% from the previous month, and you look at the various months over the last year since March of 2021, it's never exceeded a single percentage point. Now it has 1.2%. That's higher than the 0.8 in February, the 0.6 in December and January. And you look at the breakdown, inflation stats, meat, poultry, fish, and eggs are up almost 14% over the year. And by now we're quite familiar with the price trends. Okay, look at that. Bacon up 16%, pork 15%, ham almost 15%. Fish and eggs up around 11%, chicken up 13%. Cereals and bakery products, we're almost at 10% for cereals and bakery products. Flour, 14%. Bread, 7%. Fresh whole milk, 14.5% increase in price over the last year. Man, that slams working families. Fresh fruit, 10%, and it goes on. Now, the energy is off the charts, and that, of course, is owing in part to some exogenous factors like the war in Ukraine. But if you've kept up with these inflation updates, I've looked at prices across the board, including energy prices. Gasoline prices and energy prices have been going up before the conflict broke out in Ukraine. So even if that's played a role, this is part of a larger trend that predated the war. New vehicles up 12.5%. In fact, look at this. This is price of new vehicles from 2002 to 2022, and you see the graph there. And look at what's happened since 2021, just shot up. And from what I understand, there's shortages in semiconductors, and so there are some other factors here at play than just growth in the money supply. There are supply chain bottlenecks in certain sectors, but nevertheless, prices are going up across the board, and I'm not going to beat a dead horse again in this video, but I've shown in other videos why I believe that has to do quite clearly with bad monetary policy since a pandemic 2 years ago broke out. The Federal Reserve has greatly and inordinately expanded its balance sheet, and that's had an effect on prices across the board, even as these other variables drive prices upward as well. Appliances, furniture, bedding, apparel, hotel, motel, lodging, you name it. So, why are some people today a little optimistic? Well, core inflation, core CPI did not rise as much as the market had anticipated, and that's why. So now, actually, when the markets opened up this morning and the CPI numbers came out, actually the Dow went up because core CPI did not rise as significantly as people had thought. Now the Dow is down again. I think it's down like 200 points at the making of this video. So this is a bit of an outdated headline. The U.S. stocks are now down for the day. But if you take a look at this graph, first of all, what is core CPI? Core CPI is a CPI minus food and energy. Minus food and energy. A bit on that in just a second. In the blue, you see the CPI. So we're at 8.5%. And you see the graph there, trending upward. If you subtract food and energy, there's the naive optimists are looking at this. Oh, it's flattening out. It's beginning to flatten. Okay, if you want to think that, you're welcome to. But they're looking at this. It didn't. Core CPI didn't go up to here, and so because it's a slight flattening, that must mean inflation has peaked. Not so much. Now, here's core CPI. This is over the year. Yeah, so 12-month period, excluding food and energy. In February, core CPI was 6.4%. It's still higher than it was in February for March. It was 6.5% for March. So core CPI actually went up in March. But again, not as much as people thought. So, inflation's peaked. Now, why do economists and financial analysts look at core CPI? Because you're like, subtract food and energy, that's like more than half my budget. And there is reason for it, there is some use in looking at core CPI. Okay, that's not to say that food and energy costs do not impact ordinary Americans. Obviously, it does. But the reason why economists will look at core CPI is because the energy sector and the food sector, to a lesser degree, can be a bit volatile. So if you really want to see the underlying fundamentals of price stability or lack thereof, it may be useful to subtract those more volatile elements and look at broad prices outside of those sectors. So, for example, these are energy prices from 2002 to 2022, the CPI, and you can see it's volatile. Okay, it's volatile. It can be. Energy prices can go up for a number of reasons. It can go down for a number of reasons, as we've all experienced over the course of our lifetimes. Food prices, to a lesser degree, can also be volatile. And so, by just looking at core, you may get a better sense of what's happening. Now, here's why this is foolish to look at the numbers, core CPI numbers that came out today, and be optimistic. This is core CPI from 2002 to 2022, and this includes the numbers released today. So this goes up to today. Okay, this is not reason to be optimistic. Okay, how you say, inflation's peaked. I don't see that. I don't see that at all, actually. I see core CPI as just going up, up, up. Now, and you look at, this is from 2012 to 2022, 6.5% core CPI so far this year. This is over a 12-month period. Prior to 2021, it was ordinarily below 2% or definitely below 2.5%. So the core CPI this morning is 6.5%. It's like, whoa, all right, inflation's under control. No, it's so you can see the desperation here in the markets of grasping at straws, hoping for something good out of today's numbers. But this just doesn't cut it. Now, this is core CPI month over month, and this is what they're talking about. All right. If you look at month over month, CPI core rose in March 0.3% from the previous month. So CPI core rose 0.3% from the previous month. So CPI more broadly rose 1.2% in the month of March. In other words, food and energy drove a lot of that movement. Nevertheless, look at, in February, core CPI was 0.5%. And then in January and December, it was 0.6%. And then November, 0.5%. October, 0.6%. And then you get to September, and it was 0.2%. August, it was 0.1%. July, it was 0.3%. So if a 0.3% change in the month-over-month core CPI for March signals that inflation has peaked, well, why didn't inflation peak here when core CPI was even lower? Month-over-month change. So that doesn't make any sense. And in fact, actually, core CPI month-over-month, the change in the summer, last summer in 2021, was approaching a single percentage point, which is way higher than what it was in February or January or December. And then look what happened. It went down a whole lot. But as we know, inflation got worse ultimately in the coming months following that. So yeah, again, this is grasping at straws. If we were to have, so when the April numbers come out, and then the May numbers, and then the June numbers come out, and we see a consistent, fairly low increase in core CPI month over month, then that may signal something. But then, even then, I would ask, well, what's going on with food and energy? Energy, I'm more willing to accept. Okay, that might be due to other factors outside bad monetary policy. But what about food? And food's just going through the roof. The price of food's going through the roof. So this is just the spin. This was all spin. Okay, what you see here is spin. Okay, it's trying to take in a really bad number of 8.5% and saying, oh, look, core CPI didn't rise as much as we thought. The expectation was that core CPI for March would be 0.5%. It was 0.3%. Oh, inflation's peaked. Not so fast. Yeah, so this is the core CPI month over month, a little zoomed in here from May to March. Not so fast. This is what concerns me, okay? At the end of the day, the fact of the matter is the CPI, more broadly, just the plain old CPI, went up 1.2% for the month of March and up 8.5% for the year. That's the number that really matters here. Don't let them distract you. The fundamentals here haven't changed, okay? A 0.25% hike in the federal funds rate, which didn't even take effect until late March did not cause this to go down at all. So now, what's the Fed going to do? Traders bet on an aggressive Fed and predict half-point rate hikes in May and June. So that's the expectation. The Fed's going to meet again, I think May 11th, if my memory serves me correctly, or thereabouts, and they're going to make a decision on the interest rate. Right now, the target rate is between 1/4 and 1/2%. The expectation is that they're going to raise it by 50 basis points, which would take it to 0.75% to a full percent in a single meeting. Then you might see another 50 basis point hike at the next meeting after that, depending on how the numbers are. To go back to this very briefly, another reason why the stock market replied initially positively to the news today of Core CPI not meeting the expected 0.5% that people thought was there was hope, okay, maybe this will cause the Fed at its next meeting in May, maybe this will cause the FOMC to not go with a half-point rate hike and just go with a 1/4 point hike. I don't think that's going to happen. I think my prediction is the Fed in May, and we'll see in the minutes here, they're signaling that the Fed in May will indeed raise the federal funds target rate by 50 basis points or 1/2 point, and that will be done in May, and then we'll probably at subsequent meetings, if the Fed does this and raises the target rate by 50 basis points, this will be the first time in more than 20 years that the Fed has taken such action. The Fed's always done just 1/4 point hikes or has lowered it, the Fed has actually lowered it by more than 1/4 point in the past, but the Fed has never raised it by more than 1/4 point since the year 2000, I believe, was the last time the Fed did that. So we're going to see rate hikes and then quantitative tightening. And I did a whole video on this. You should watch it if you haven't seen it, explaining quantitative tightening. The vice chair of the Federal Reserve Board in Washington, D.C., alarmed markets last Tuesday, a week ago, when she said that the Fed will begin reducing its balance sheet as soon as May, and that the Fed would do so at a rapid pace. And this was especially alarming because Leo Brainard, who is close with the Biden administration, she's dovish on monetary policy. She supports more of an easy money Fed governor. So the fact that she's saying that this is going to happen at a rapid pace tells us something, okay? It tells us that the Fed is indeed going to act. The Fed must act, and the Fed understands us. They've got to act, and so we're going to see probably 1/2 point rate hike and then quantitative tightening. She said the FOMC will continue tightening monetary policy methodically through a series of interest rate increases and by starting to reduce the balance sheet. So quantitative tightening, the opposite of QE, or quantitative easing. And she said we'll do so at a rapid pace, as soon as our May meeting. I expect the balance sheet to shrink considerably more rapidly than the previous round of QT. So I explained this in my video on quantitative tightening back in 2017. Through 2019, there was a brief period of very moderate quantitative tightening. She's saying that this is going to be much more aggressive than in 2017, 2019. Back then, the Fed allowed $50 billion in securities, usually treasuries that matured, to roll off its balance sheet every month. So the Fed has treasury securities and mortgage-backed securities. And usually when those securities mature, the Fed will reinvest that same amount of money in new securities. What the Fed did in 2017, 2019 was they allowed up to $50 billion of those matured securities to simply roll off without reinvesting it. So it was a way to gradually and very moderately reduce the size of the balance sheet. Now, so this is a dove on the Fed board saying this. Now, the big hawk on the FOMC, Jim Bullard, he's the president of the St. Louis Federal Reserve. He's saying that the Fed is behind the curve, and he's predicting rates at the target rate, federal funds rate, at 3.5% by the year's end. Right now, this is the big hawk on the FOMC. He has a rotating chair on the FOMC, but he happens to be on the FOMC right now. And he's saying 3.5%, and he's been lobbying for tighter monetary policy in the face of all this inflation. So, to wrap up the video here, let's take a look at the minutes from the Federal Open Market Committee that came out not too long ago from its March meeting. So the FOMC met in March. We now have the minutes for that meeting. The FOMC at that meeting raised the target rate, the federal funds rate, by 1/4 point. Okay, that was the big news coming out of that. And then you'll notice here, no quantitative tightening at the March meeting. See here, roll over at auction all principal payments from the Federal Reserve's holdings of Treasury securities and reinvest all principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities. That's fancy talk for no quantitative tightening. Okay, so any securities that mature, that it will be reinvested in new securities, so no quantitative tightening. However, at this meeting, or in the minutes that we have of this meeting, the Fed signals that it is prepared for quantitative tightening. Now, there was one member of the FOMC who voted against the Fed's action, James Bullard, same gentleman we just heard from. James Bullard, he voted against the action. He was the only member who voted against. He said he preferred to hike the federal funds rate by 0.5 point, by 50 basis points. So he wanted a more aggressive action, voted against the Fed's more moderate 1/4 point hike. What else do we see from the minutes? We see that it wasn't just Bullard. It wasn't just Bullard who desired 50 basis points, but the others refrained from going that route. The minutes said that the participants at the meeting, the members of the committee, would have preferred a 50 basis point increase, but in light of greater near-term uncertainty associated with Russia's invasion of Ukraine, they judged that a 25 basis point increase would be appropriate at this meeting. So this alarmed markets a bit, because it said, oh, look, actually the Fed was going to do 50 basis points, but all the uncertainty with Russia and Ukraine, it went with 25, minus James Bullard, who wanted to stick to 50 basis points. Bullard was right, by the way. It should have hiked it more than the Fed did. Many participants noted that one or more 50 basis point increases in the target range could be appropriate at future meetings. So this signals it's coming, okay? 0.5 point hikes in the federal funds rate, it's coming, and we'll probably see it at the May meeting, particularly if inflation pressures remained elevated or intensified. 8.5% CPI when the FOMC meets next month. We'll have the numbers for April. We'll see what the new CPI numbers will tell us, but based on today's numbers, I think it's pretty safe to say the Fed's going to increase by half a percentage point at the May meeting. What about quantitative tightening? The Fed didn't enact it in March. However, All participants in the committee agreed that elevated inflation and tight labor market conditions warranted commencement of balance sheet runoff at a coming meeting. So quantitative tightening is coming, with a faster pace of decline in securities holdings than over the 2017-2019 period. So basically what Brainerd told us last week, that this will happen at a faster pace, or as she framed it, a rapid pace. And what they're aiming for, now this isn't official, but the consensus, the general agreement, was that as much as $95 billion will be allowed to roll off the Fed's balance sheet every month. $95 billion reduction every month. You take the $60 billion for Treasury securities, $35 billion for mortgage-backed securities. No decision regarding the committee's plan to reduce the Fed's balance sheet was made at this meeting, but participants agreed that they had made substantial progress on a plan, in that they will begin the process of reducing the size of the balance sheet as early as after the conclusion of its upcoming meeting in May. So QT is coming, along with perhaps half-point rate hike in May, and then half-point rate hike if inflation remains elevated, which I believe it will, through the summer. Here's the Fed's balance sheet. Now this will put it in perspective here. The Fed's saying we'll do up to 90. It's not official, but we reckon we'll probably reduce the size of the balance sheet by about $95 billion every month. $95 billion times 12 months in a year is almost $1.2 trillion. But the Fed's balance sheet since March of 2020, when all the QE madness started, when the pandemic broke out, the Fed's balance sheet increased by $4.7 trillion. And here the Fed's saying we're going to reduce the size of the balance sheet by $95 billion a month. Oh, wow. You see, when you put it in perspective, actually, so here's the point. If inflation continues to worsen, it may become clear to the Fed that they can't just cap monthly reductions in the size of the balance sheet at $95 billion. They may need to up the reduction every month. And if things got really, really bad, you may have to start just directly selling off securities that haven't yet matured. All this is going to have a big impact on the bond market. I talk about it in my quantitative tightening video if you haven't seen that. Note this as well. Several participants remarked that they would be comfortable with relatively high monthly caps or no caps. So that had to be Jim Bullard. It's like, why cap it at $95 billion? Let's open the possibility of allowing all the securities that mature in a given month to roll off the balance sheet. And then the last thing we garner from the minutes, the Fed has this convenient excuse of the Russian invasion of Ukraine. So participants agreed developments in Ukraine, including resulting sanctions, are adding to the inflation pressures. This is true to a degree. Russia and Ukraine are major suppliers of various commodities used in the production of energy, food, and some industrial inputs. True. So that's a factor that contributes to inflation. But again, this is all happening prior to the invasion. But the invasion does provide the Fed with, and it's more importantly, the Biden administration with a convenient excuse for why their inflation predictions failed. So Powell and other members of the Fed board all through 2021, inflation's transitory. If you watch my videos on inflation in the final months of 2021, I was saying this is not transitory. It's not transitory. We're talking about fundamentals here. With the conflict in Ukraine breaking out, Powell and the Fed can point to that event. Oh, see, that how could we have predicted that? This is why inflation was much higher than we anticipated. But in reality, this prices were going up regardless of whether or not Russia invaded Ukraine. It doesn't help matters, but it didn't. The fundamentals for persistent long-term inflation were still there, as seen here on the a balance sheet approaching $9 trillion when it was under $4.5 trillion prior to the pandemic. That's the reason. This is the reason for all the inflation and the 42% increase in M2, the money supply. That's the real reason for why prices are going up across the board. Not all this other stuff. The Russian invasion or recent COVID-related lockdowns in China have the potential to further disrupt supply chains. So all this will be pointed to, but at the end of the day, it was just bad monetary policy. It's bad monetary policy. Okay, so that's all for today, and I'll see you all next time. So long. Bye.